Right, so the final part of chapter 3 is on research and development. And a nice chapter, and sorry, nice section, because we're really trying to ascertain the problem is not the credit bank. The question here is what are we debiting? Are we debiting an expense, P&L, or are we debiting an asset, if you like, a statement of financial position? And of course, we would love to debit the asset because it means we can then dictate how we spread the cost over a period of time and that sort of thing. So the argument really is if it's considered research where there is still work in progress, we haven't quite, the technical feasibility is lacking, um, we may not have the financial resources to complete, it isn't ultimately ready for sale, in effect, if you like. So that definition of an asset, the ability to start bringing in probable economic benefit is not quite sure, um, then we recognize it as an expense. So key point is if it is development expenditure, if we have arrived and we'll see the sort of benchmarks, we should start amortizing as soon as commercial production begins. Oops, sorry. So I was at the wrong end of this here. So here we are. So research is original and planned investigation undertaken with the prospect of gaining new scientific knowledge and understanding, whilst development is the application, if you like, of those research findings in effect. And we have enough information for the production of new and substantially improved materials, if you like, before the start of commercial production or use. So we typically write off research expenditure, and we, again, like I said, with development now, we can demonstrate that there is probable future economic benefit, and there is intention to complete the intangible and use it and sell it. So what are we looking for? This idea of key point is we have the resources available to complete the development. There's a technical feasibility. It is expected to be profitable, and the cost of the project will be exceeded by the benefits generated. Yes, so that's the key. That's really the key point. Yeah, so if an item is so here is scenarios where we are using assets within the organization, focusing those assets in on projects to do with R&D. So if an item is used in the development process, the depreciation on the plant is added to development costs in intangible assets during the period that the project meets the development criteria. So we can sort of allocate some of that depreciation cost to the asset, to the development sort of development costs for that period. So you get those scenarios. So I think it's just important just to have a look at TYU1. Let's just look at it. I'm just going to cross over to the text here. This is just an example here. You can see it says an entity has incurred the following expenditure during the current year. So 100,000 spent on the initial design work of a new product. It is actually, I'll show you the pirate thing here. Pirate, probable flow of economic benefit, intention to complete, reliable measure of development work, resources available to finish, technical feasibility. So some professor somewhere has said this is good. It will lead to a product. It's expected to be profitable. The cost of the project will be exceeded by the benefits generated. So a number of issues, a number of things there for you to be able to pick out on to decide whether or not it is it's crossed over to being development. So 100,000 spent on initial design work. Anticipated that this design will be taken forward over the next 2-year period to be developed. So we are in the research phase. So this is all expensed. Here we have 500,000 spent on the testing of a new production system designed internally, and which will be in operation during the following year. So we can see here that there is a benefit, probable economic benefit. Here we see a fall in production costs, and therefore this will be capitalized because we can see that this thing is being brought into operation. So we have evidence of technical. We have evidence. Let's see the best one for this one here. It is the probable economic flow because we're bringing it into operation in the next year. And there you are. So this is capitalized. Let's look at TYU2 quickly. Entity has incurred the following expenditure in the current year. A brand name, purchased for 200,000. So very good. Clearly, we have bought this thing. We can clearly, reliably measure it, recognize it at 200. The question here is, do we revalue? So the standard just prohibits you from rebranding. Standard says no, can't, even though it's a brand specialist. Because again, this question is about homogeneity and an active market. Can we argue that we can find similar brands in an active market? Not really. So for prudence, keep it at 200. 500,000 spent on developing a new line, 150 for research. So 150 for research, great. And the balance of 350 capitalized, because we can see here 150 was spent before approval was given to fully fund the project. So there's funding for the project. We can assume comfortably that 350 is development. And finally, training costs. New manufacturing training amounts to 100,000. Staff are expected to remain for 5 years. We never capitalize training costs because technically these aren't separable assets. Cannot, even though you can measure it reliably, you do not control this asset. These people can leave whenever they wish. So you must expense training costs immediately. Cool, great stuff. And that is the end of chapter 3 on intangible assets.